I want you to try this on your own. I don't want you going to any solution yet. I want you to really knuckle down and do this problem. You're given some information on XYZ Corporation, and then asked to make some calculations given this information. You'll notice that in the information, you're given information about assets, liabilities, and owner's equity as of 12/31/X1 and as of 12/31/X2. Now, you're not given all the information. There are some blanks. But the basic nature of this information is information from a balance sheet at the end of one year and at the end of the following year. And so you're looking at comparative information, which suggests that this diagram has some application in this problem. Go for it. Okay, now let's look at the solution to this problem. One way to approach this problem would be first to simply recreate the diagram by showing the amount of assets, liabilities, and owner's equity at the beginning of the year, and then trying to fill in the blanks for the information that's known. And they did tell us that the total assets amounted at 12/31/X1 amounted to $100,000. They didn't give us any information about liabilities, but they did tell us that owner's equity amounted to $40,000. And by the way, I can now solve for that beginning balance of liabilities. Since I know that assets amount to $100,000 and that must be equal to liabilities plus owner's equity, then liabilities must be $60,000 given that owner's equity is $40,000. Then again, doing a comparison of the beginning balance sheet and the ending balance sheet to discover any changes or trends in these elements of the balance sheet, I'll go to the ending balance sheet at 12/31/X2, and they don't give me nearly as much information, but they do tell me that assets amounted to $130,000. But they don't give me a balance of liabilities or of owner's equity, and as a result, I'm kind of at a loss here. In fact, one of the numbers that I'm supposed to calculate for the solution of this problem is the ending balance of owner's equity. And at this point in time, I don't have enough information to make that calculation. And some people may say, well, gee, where do I go from here? But let's go ahead and see what other information we can derive given a more expanded application of this diagram. We can calculate, and the next step here in the diagram is to identify how much the balance sheet changed from the beginning to the end of the year. Did assets increase or decrease? I mean, that is what we're trying to do here, is determine whether, what the trend was in assets. Is the business growing or is it contracting in terms of the amount of assets? And the change in assets was an increase of $30,000. It went from $100,000 at the beginning of the year to $130,000. So we can fill in that particular blank. But in terms of the change in liabilities, which is, again, one of the elements of information that we're trying to calculate in this problem, required for the solution, I don't see how I can make that calculation. I know the beginning balance of $60,000, which I derived, but if I don't know the ending balance, I certainly can't calculate the change. And I've got the same problem with the change in owner's equity. Again, I don't see that there's any way that I can make that calculation given the information provided at this point in time, so I'm going to either leave that blank or put a question mark there. But I did realize that I can expand down in this diagram to explain the change in owner's equity a different way. If we can identify the change or increase or decrease in capital stock or capital contributions during the year, plus any change in retained earnings for the year, X2, then that would be another way to determine any change in owner's equity. They do tell me or provide information that the change in capital stock or capital contributions during the year amounted to $10,000 or an increase of $10,000. But again, they don't give me any information relative to what the change was in retained earnings during the year, which is, again, one of the other items of information that this problem asks me to to determine. And I do not have an equation here that really allows me to make that determination, at least at this point in time, because I don't know the change in owner's equity. I know that two things account for that change, but I only know one element of that being capital contributions. And so I'm kind of stuck here. Except that I remember that I can expand this diagram because any change in retained earnings only takes place as a result of earnings during the year, net income during 20x2, minus any dividends for the year. Now, they don't tell me what my net income was for the year. In fact, that's again an element of information that they want me to derive. But they do tell me dividends of $35,000. But again, that doesn't really help me because even in this little equation here of change in retained earnings equals net income minus dividends for the year, I don't have enough information. However, I do know that I can expand net income because net income is really defined in terms of revenues for the year minus expenses for the year, and here is where I get some help because this problem does provide the amount of revenues and the amount of expenses. Revenues amounted to $250,000. Expenses apparently amounted to $225,000. Well, I can now solve for net income. Revenues minus expenses during the year X2, or the period of time, equals the net income for that period of time, by definition. The net income must have been $25,000. And if my earnings or net income for the year amounted to $25,000, and dividends were paid out of $35,000, by the way, that kind of concerns me. Because can you pay out more dividends than you had earnings? What do you think? Can you pay $35,000 of dividends when in fact you only had net income or earnings for the year of $25,000? Is there a problem here? Well, yes and no. I mean, it is true that you cannot take $25,000 of earnings and out of that $25,000 of earnings pay out $35,000 of dividends. It's just not possible. But it is possible to pay dividends not only from this year's earnings, but from earnings in prior years. Remember, we probably have been earning and retaining some of those earnings in prior years, and in this year, I could decide not only to pay all of this year's earnings out as a dividend, but maybe any prior retained earnings. Now, this problem tells me that at the beginning of the year, owner's equity, which is capital stock plus retained earnings, amounted to $40,000. They didn't give me the breakdown of how much was capital stock or how much was retained earnings. But clearly there must have been at least $10,000 of retained earnings in that $40,000 owner's equity amount because we are paying out $35,000 of dividends and we can only pay dividends from earnings in the current year or any previously retained earnings from years prior to the current year. Well, what I'm really telling you here is that apparently we must have paid out dividends, not only all of the earnings of this current year, but also $10,000 of earnings previously retained in the business, such that retained earnings decreased this year apparently by $10,000. There's no other conclusion. If retained earnings went down by $10,000 and owners made capital contributions of $10,000, and those are the only two things that can contribute to a change in owner's equity, the change of owner's equity must have been zero. If the change in owner's equity was zero, and owner's equity started at $40,000 at the beginning of the year, what must be the ending balance? If there was no change, the balance at the end of the year for owner's equity must be $40,000. And by the way, if owner's equity is $40,000 at 12/31x2, then I can calculate the amount of liabilities because I have an equation here, assets equals liabilities plus owner's equity with two known amounts and one unknown, and so I can solve for liabilities, that must be $90,000. And finally, I can determine the change or increase in liabilities. If liabilities started at 60 and the ending balance that we've determined is 90, liabilities must have increased by $30,000. In fact, let's kind of verify that by looking at this equation where total change in assets of $30,000 must be equal to the total change in liabilities, which is $30,000, plus any change in owner's equity, which was zero. And therefore, the changes in these elements is in balance in terms of assets, liabilities, and owner's equity. Final summary, if we just stand back for a second, we can really talk more about this business, noting that this business has grown over the last year. That growth in assets has been financed completely by debt or borrowing of assets, an increased borrowing of $30,000. Apparently, owners have provided capital to the business, but they actually reduce the total amount of owner's equity by taking out substantially more dividends than they had earnings in the current year. This company was profitable, but paid out more dividends than they had in terms of income. You know, this is really kind of strange, and if I were talking to these business people, I'd say, why the heck would you have taken out a dividend of $35,000 and then turned around and taken some of those dollars and contributed it back to the business in terms of a capital contribution? Frankly, this doesn't make business sense to me. And it doesn't make economic sense either, because you have to pay taxes on any dividends. And so it doesn't make any sense to take a dividend of $35,000 as an owner, pay taxes to the government, what may be, almost 40% of that, and then take what's left over and start making contributions back to the business. We probably shouldn't have taken out so much in the way of dividends, only $25,000, and made no capital contributions, and we would have paid, substantially less to the government in the form of a tax. But anyways, hopefully we understand what's happened here and also make an analysis of the intelligence of management in terms of how they've structured their capital organization during this last year. Okay, did you like that? Well, I want you to do another problem. This is so important, we need a little additional practice on it. So again, on another sheet of paper, just continue on this one, I want you to now respond to the following question, which again deals with changes in your balance sheet from the beginning to the end of the year, and understanding how those changes come about. Go ahead and do that problem. Okay, let's walk through this problem. Again, another important problem, and kind of bringing all of this language together and understanding how it can help us interpret what's happened for a business from the beginning to the end of a year, or develop some trend of activity. Again, I would start out this diagram by identifying assets equals liabilities plus owner's equity at the beginning of the year. They don't actually give us the date here, so I'm just writing the beginning of the year. And frankly, the only amount that they give me that indicates an amount at the beginning of the year is they do tell me that liabilities amount to $75,000, but they don't tell me the amount of assets or owner's equity. At the end of the year, they also don't give me the assets or owner's equity. They do tell me that liabilities are now $65,000, and the next step in the diagram would be to identify then the change in assets, liabilities, and owner's equity. And clearly I can calculate that there was a change in liabilities, a decrease in liabilities amounting to $10,000. Now, they don't give me the information that allows me to calculate the change in assets, but they did simply say that assets increased during the year by $25,000. The increase during the year is the change during the year, so $25,000 is the appropriate amount to reflect in the diagram under the change in total assets. And by the way, even though I have no information for owner's equity at the beginning or end, I can calculate the change in owner's equity, because if I know that total assets increased by $25,000, but liabilities decreased by $10,000, in order to make the change in assets equal the change in liabilities plus change in owner's equity must have increased by $35,000. An increase of 35 plus a decrease of 10 equals a net increase of $25,000. See, I can tell you already that this company has grown by $25,000 in total assets and has also paid off debts in aggregate on a cumulative basis of $10,000. And therefore, they financed the increase in assets of $25,000 by getting from owners $35,000 that allowed them to buy $25,000 of additional assets and pay off debts to the tune of $10,000. Remember that any increase or additional resources provided by the owners is explained either by capital contributions during the year or by allowing earnings, assets created through profitable operations, earnings to be retained in the business. Now, it tells us that capital contributions amounted to $10,000. If in fact that's true, and the total increase in owner's equity was $35,000, what must have been the change or increase in retained earnings during the year as a result of those two items of information? Retained earnings must have gone up by 25. 25,000 plus 10 capital contributions equals a $35,000 increase. So the way we owners provided resources to the business was by making additional capital contributions and by allowing earnings created that year to be retained in the business to the tune of $25,000. But we can expand this even further because we know that any increase or change in retained earnings is as a result of the earnings for the year that are retained in the business, or the earnings less any dividends that were paid. In this particular case, they tell us that the dividends amounted to $12,000. If we paid out of our earnings dividends of $12,000, but the net change in retained earnings was an increase of 25, then net income for the year must have been $37,000 of net income, and then if you take out of that net income some of those resources created to the tune of $12,000 and pay it in dividends, then we're retaining in the business $25,000 of our profits. That explains the $25,000 increase in retained earnings. If you know that net income was $37,000 for the year, and you expand that further to reflect that net income is a result of revenues for the year less expenses, and in this particular problem they tell us that expenses amounted to $100,000, then you can back in or calculate what revenues must have been. Revenues must have been $137,000 if net income was $37,000 and you had expenses of $100,000. $137,000 of revenues minus expenses of $100,000 is net income of $37,000. Revenues must have been $137,000, and that's the answer to the problem. And again, hopefully you can become fluent and efficient in approaching problems like this, which is really just a test to see if you really truly understand this language and terminology and how to interpret it given a set of financial statements from one year to the next.